You guys all look nicer than me. I guess I forgot that. Oh, this world.
Cindy takes the cake for sure.
Absolutely.
Yeah. It's Wednesday, I showered.
Every day's the same. All right. So nice to have everybody here, and the beautiful backgrounds. So welcome everyone to Rethinking Innovation, how banks and credit unions can leverage FinTechs to unlock growth and efficiencies. A panel discussion presented by Community Capital Technology. Oftentimes when a crisis hits, it's the innovation centers and investment in technologies that takes a hit. These programs are seen as nice to have, especially in a mature industry such as banking. Our discussion today will focus on the ease and accessibility of FinTech partnerships that organizations can leverage as turnkey options to drive growth and efficiencies. Before we get to our group, I'd like to thank the strong team at Community Capital Technology that pulled this panel discussion together. I'd be remiss if I didn't single out Rolanda Nelson, COO of Community Capital Technology, for her insight, industry experience that has guided us on today's program, the second in our webinar series. I'm John Marinelli. I'll be tasked with moderating and facilitating the discussion. I spent 20 years working at large financial institutions, and I followed my passion into FinTech in the past year. I'm incredibly excited to engage this panel. When we consider the options for innovation, you have the ability to build, buy, or partner. In my experience at a large institution, I've always been tasked with either building or buying. These were always hard. They took an outsized amount of effort and resources that often sidetracked the business, weighing down the group that they were tasked at helping. Without further ado, let's get into some of this. Garrett Smith, a FinTech entrepreneur who early on realized the importance of providing community banks and credit unions innovative solutions. His unique offering at Community Capital can be applied across both consumer and small business loan markets. He allows for connection, analytics, and balance sheet optimization resources. Garrett, thank you so much for your time today, and I'd like you to say a few words.
Yeah, well, first off, thank you, John, for moderating, and thank all the panelists for making some time for us this afternoon ahead of a holiday weekend, and also thank you to all the participants that have joined us this afternoon. I think we've got a really strong mix of both financial institutions as well as financial technology service providers, so we're very excited about that. And this afternoon, as we discuss innovation, I think it's a more prescient topic than ever, given the murky waters that we're all trying to navigate, and how we can all be adaptive and flexible to the new environment. So thank you everybody for joining.
So thank you so much, Garrett. So Cindy Blankenship is the vice chairman and COO of Bank of the West in Texas. Her husband and her struck out to found Bank of the West in 1986 and now preside over a 7-branch community bank organization. Cindy has the unique position of leading the ICBA, the Independent Community Bank Association, through the 2008 financial crisis. Her steady, energetic, and reassuring leadership has been well chronicled as she was called to testify on Capitol Hill and before the House Financial Services Committee during those particularly challenging times. Hi, Cindy.
Good morning.
So next up, we have Jay Fee. Jay, over the course of his career, has supported businesses across financial services, credit union, e-commerce, and automotive industries, with a focus on creating a culture of growth and innovation. He began his career at Navy Federal and is currently a senior executive at Pentagon Federal. Since joining PenFed in 2019, he has already put in place a number of substantial FinTech partnerships and continues to drive forward innovation for revenue and client acquisition strategies. Welcome, Jay.
Thank you.
And now batting cleanup, we have Mike Butler. Mike has a long history of traditional banking in both consumer and commercial credit, helping to grow KeyCorp into a $100 billion banking behemoth before striking it out on his own to be CEO of Radius Bank. Mike has forged a unique strategic direction, fostering a culture of innovation, technology leadership in the banking and FinTech circles. Mike's forward thinking has driven the team at Radius to develop partnerships that share in the ethos of both providing excellent customer service along with a respect for the regulatory environment. Hey, Mike.
Hi, John, thanks.
So I think what we can do is we can dive right in, and if you guys need to clarify with me, please do. What we'd like to do is, some of these questions are fairly well polished, but what we want to do to get for the audience is really get at the heart of taking the most advantage that we can out of a FinTech partnership. So Cindy, I'll first engage with you. What are some of the things your organization is doing to work with new to bank clients, typically here as the result of the PPP? And what are the things that they've been receptive to in regards to your relationship model of banking?
Well, I think I'm not unlike any other bank in that once we secure a relationship with the customer, that's really what they rely on, because let's face it, the services are just commodities that you can get at any financial institution. But as corny as it sounds, and I think it's overused sometimes, but it really is the meat of difference is to just have that one-on-one relationship with a client. And what we found during the PPP application stages was that we were getting a lot of applicants, particularly from some of the larger institutions, that were either being told you don't matter, basically you don't qualify. If you're not already an established high dollar loan customer on the business side with us, you're ineligible to qualify for our program. So a lot of these customers were being turned away, and these were really core, good small businesses. So as innovative as we thought we were, we found that we actually had some weaknesses, and we were pleased that SBA and Treasury allowed us to deliver the loan documents electronically, to come up with our own loan documents. But it did get us off the back burner on several projects. One of those being electronic signatures, which we're in the middle of right now. We've been toying with it for a year, but quite frankly, I think we just got lazy and complacent. So that's something, online opening of new accounts and perhaps online applications, because virtually we handled everything online. So I think looking forward, we'll have to look at electronic delivery and delivery.
Wonderful. That's really informative. I really appreciate that. Now, Mike, as a community banker yourself, what are some of the technologies or services that you think will keep these new to bank customers at the institutions? What are you hearing from them?
Well, if you're talking about PPP clients who have kind of joined our organization through that process, I think what you're going to find is, you know, we're kind of saying there's an upheaval again in this small business SMB segment, in which it's been a tossed about segment for years, you know, amongst big banks and small banks. You know, it's in favor and out of favor, and I think the victims are the small businesses themselves. I think there's been a shift in how you even, you know, what small business is today. You know, have a lot more technology-based small businesses that are looking for technology from their bank. That's the way we would view this. Is I think because it's a bit of an underserved segment, there's a desire for them to have more treasury management services delivered electronically. Surprisingly, from our perspective, it is more about the depository services than it is the loan sometimes. And so I think they want to be involved with, you know, products and services that can be delivered electronically and virtually. We, you know, throughout this process, we we had already launched a small business virtual deposit product. And what we found is that almost all of our clients are choosing to have their PPP loans funded into our tailored checking account, and are just absolutely thrilled with how easy it is to open the account and some of the attributes associated with it. So that's where our focus is going to be on, that particular product and what we think that segment is looking for.
Excellent, Mike. And just a quick follow-up. So some of these some of these institutions, small businesses in general, it's a tough market for a bank to scale. Do you think technology will be able to bridge the gap here?
Oh, sure. Yeah. I mean, it always has, right? That's where the emergence of credit scoring came in on the loan side was, can we eliminate underwriters and do 50 to 100, now $250,000 loans? There's still some great technology companies out there, FinTechs, that are still trying to figure that part of it out. It's a bit of a challenge. We've taken the other side of it and said, you can open up a small business checking account with us, virtually in 3 to 4 kind of minutes. And so that kind of solves some of the problem. That's a very scalable, type of, process. So, today we onboard 400 small business accounts a month before PPP with our technology, without a branch network.
Wow, interesting. Now, Jay, to you, on the consumer side, from your perspective, looking at sort of client acquisition and retention strategies through the lens of FinTech partnerships, where are you at right now?
Yeah, so it's interesting. Prior to everything happening and changing in March, really for us, we had been in the process of fast tracking our what I'd call FinTech development, pivoting more to unsecured lending, trying to establish an originate to sell model, basically generating billions of dollars of loans, but not necessarily holding all of it on our balance sheet, which was fundamentally drastically different from where PenFed was probably even 24, 36 months ago. I remember back in right after 9/11, I had just joined a small FinTech and couldn't understand, in the midst of all the things that were going down after 9/11, why our CEO was so upbeat. And finally I took him aside and I said, you don't really have to be that upbeat for me. I understand things are going to be really tough over the next couple of months, maybe even a year. And he looked at me and he goes, Jay, you don't understand. You just got a mulligan. You got an extra 6 to 9 months to go out and build out the business that we talked about. And that literally, that discussion really set the stage for triple-digit growth for that business that I was in there from 2001 to 2007 in the technology environment. And we've had those same discussions here at PenFed with everything that we're trying to do. There was all the distractions of building the business, running the business, et cetera. And what this has actually done is provided a little bit of an opportunity for us with all of the relationships we're trying to establish and all the things we're trying to do to actually move faster. We have everybody's attention now. We have everybody's focus. And everybody realizes that this is an opportunity really for us to build everything out and not be so obsessed with the daily in numbers and sacrificing the short term for the long term. So this is really our time to really go out and build that. And it's not just for PenFed, it's for everybody. And so this whole building the balance sheet process, we're doing that in conjunction with community capital, and the whole originate to sell piece is something that's really, really starting to take hold for us. And we're going to do this probably about 12 months faster than it would have happened if we hadn't been going through this crisis.
So Jay, to that point, do you think the days of technology being viewed as non-core, non-critical to a bank or financial institution, do you think those days are over, or do you think those days are numbered?
So it's different now. It used to be that the bank had to build and own the technology or buy it. It was always FinTechs or banks. And then it was, okay, you don't want to help the FinTechs because they'll become banks. I mean, everybody's realized now the ecosystem is big enough for everybody. And now really about speed. And the way you do speed is partnering. Yeah, you can build it yourself, but if you totally rely on building it yourself, hey, you're kind of you're setting yourself behind, because you might not build it as fast as you will. You probably won't. And then if you're going to try and buy it, you always don't know what you're going to get. And necessarily what you're buying, and by the time you integrate it, isn't necessarily what you thought you had. So partnering with FinTechs is really a great way to at least learn on somebody else's dime and get good at it before you try and do it all on your own, if that's really what your strategy is.
No, I completely understand where you're coming from there. Now, Garrett, what are the conversations that you're having with banks, credit unions, and the like? Are they surprised at the partnership opportunities?
No, I don't think they're surprised. I think perhaps what they were surprised by was the new client acquisition that came as a result of the PPP. I think a lot of that client acquisition in large part outpaced the organizational capability to service it. And that resulted in a more evolutionary approach to technology partnerships than something that may have historically been looked at as extremely disruptive. So I wasn't particularly surprised by that. And I think those organizations that were prepared for it and had existing partnerships in place were really the ones that ultimately won out. And, you know, before we got started here on the call, Cindy and I were talking about some of the challenges that Chase had with their program, where they scrambled to try and put some technology solution in place at the last minute. It caused some companies to get double funding. Many of the clients that they should have been financing actually went to banks like Mike's and like Cindy's as a result of that. So I think, you know, those banks that were already set up to process and approve and service those clients were the ones that ultimately won out in the process.
Wonderful. Okay. Now, moving on. So I think, you know, when we look at 2020, right, like if the 2020 strategy, you know, heading into, you know, the fall and into the winter, if it was, say, a picture of 10s, 20s, and $100 bills, you know, what actually has happened in 2020 is, you know, the armored truck going down the highway with the doors open and the money going everywhere. You know, it's certainly unexpected. You know, how has this sort of changed the roadmap for innovation? Do you think it's a slowdown moment or a speed up moment or a stop altogether moment? Do you think that this is going to be a mark where there's a sea change in attitudes towards technology and banking? Mike, I'll start with you for that.
Well, you know, it's, you're asking one guy's opinion, so I want to be careful, but yeah, I think there's a lot on a CEO's mind today that is a little bit more pressing than pushing forward with technology. If I'm looking at historical kind of events that have taken place, it is, I think today bankers have to figure out what the landscape's going to be from a capital and asset quality perspective. There is no doubt that that's going to be a concern for us down the road. The government stimulus package has been outstanding, and I think all of us hope for a sharper rebound, but we are in a recession. There is going to be fallout. GDP may come back very strongly, but it will be a different type of GDP than it is today. We know that. There'll be some winners and losers, and we all don't get to pick the right winners and losers. There's not enough foresight that goes around. So I think there's some distraction there. I think there's some distraction on how we deal with people and how we deal with our employee base that is very important for the culture of companies. So I would put those two up there to say, if I were going to take a stab at, if you haven't invested in technology and you haven't been planning to, you're going to be distracted a little bit. So I don't know. I think it's going to take a real strong commitment from CEOs that haven't been engaged to get engaged over the next 6 to 8 months before we figure out what the world's going to look like. But I would tell you from our perspective, because we've got a technology roadmap in place and because of what we've seen, we're in an accelerated mode. So because we think of ourselves more as a technology company than a bank, then I think what we've seen kind of play out in front of us is an absolute kind of push forward in where the future of this industry lies, and for us to go get it faster even. And I think and you know, we have this view that small businesses will want technology. We've built some, you know, a technology for it that's got to go faster because there'll be a, you know, a higher level of demand. But again, I'm trying to be balanced here. We're a fairly unique bank. You know, we're different than a lot of people. We've been doing this for 5 years. That's a long time to be committed to it. But I think the industry is going to be challenged in the short term to maybe jump on this opportunity. But you know, kudos to those that will be able to.
Now, Cindy, to you, you founded your bank amidst a crisis, really, in the mid to late 80s. How has this current level of crisis changed your thinking, modified your thinking into, you know, what you were planning to do in 2020, specifically towards partnerships or technology initiatives?
Right. Well, I think one thing that's been very beneficial coming out of this crisis is that before, where we tiptoed into technology, particularly smaller, mid-sized community banks, because oftentimes the regulators, you know, warned us. We were wearing this overshadowing hat of risk and judgment from the regulator, and you know, of course, third-party due diligence was like the buzzword. With this PPP product, it forced the regulators to accept the fact that we had to get out there and do things differently and modify our delivery, and in turn, they would have to accept it. So I think there's been a certain level of comfort, if you will, that we've received from being forced into what would have been nice to have as a technology tool is now a necessity. And I believe it will be a necessity going forward. Now, I would echo a lot of Mike's comments that there will be some distraction, but there's also going to be opportunity to look at maybe some loan grading tools, some of that type technology, because I think we're all in agreement that there may be a credit crisis 6, 9, 12 months, maybe even longer down the road. And any tool that we could implement and get a vendor on board that would help us in the short term and the long term. And most likely the regulators, where they used to be very reticent to endorse anything right off the bat, will allow us a little extra rope in that regard.
Right. Excellent. Thank you so much. Now, Garrett, how can community capital help incumbent banks, credit unions, and the like during this time?
Absolutely. So I think Cindy, you know, couldn't have said it better. I think we are going to see a credit crisis coming down the pipeline. I think as some of these deferral programs start to wear off, looking very closely at the portfolio and how to optimize it is going to be front and center. And I think, you know, just also dovetailing off Mike's comments, we've structured our platform as a plug and play tool. You know, a lot of times people think about partnerships as some massive integration and some opportunity cost where, you know, they're going to either have to take the credit team or portfolio management or the bankers out of the field in order to implement something. But, you know, we can have a partnership established in a matter of a day, and we can have users up and running in 5 minutes. You know, we've invested heavily into our information security policies and program, and our technology team, including our CTO, Rod Saunders, has done a fantastic job of putting that together. So when we go into a potential client, you know, we can really, you know, fly through that vendor management program and thus begin to act as an exchange where folks can not only find prospective buyers and capital partners, but they can also get very relevant and timely data around where some of these opportunities are being priced and traded, not just within their own market, but nationally as well. So we think that this is going to be a really big opportunity for us as well, not just to help our existing partners, but also to gather new clients at the same time.
Interesting. So now with any sort of change or innovation, it requires risk taking. And I spent my career in risk management, so I feel like I know some of the answers here. But when we talk about responsible innovation, you know, this one's to Jay. How hard is it, and where do you put your energy towards keeping internal risk teams and external regulators happy? What's the dance that you have to do, and is there anything that you can offer to people that are looking to get started, maybe for the first time, dealing with outside partners?
Well, of course, it's always about picking partners wisely, starting with the end of the question there. Prior to coming to Penn Fed, I built a FinTech from ground up to a Series A. And did it while working for a guy named Nigel Morris, the guy who started Capital One, managing director of QED Investments. It's done Credit Karma and a whole slew of these fintechs. So he was very keen on me when we were starting, saying, "Hey, look, when you're going to go ahead and do this business, one of the first things you need to do is hire a compliance person." I'm like, really? We're kind of like, don't we need to get up and running and you'll be more focused on sales and origination and technology? And he said, yeah, absolutely. But one of the first few people you're going to hire is compliance. And he goes, if you don't, then you're exposing yourself to risk, and you're exposing the partners that you're going to be to risk. And so, you know, that's something you need to take hold. And also, if you're on the flip side, obviously on the financial institution side, is make sure that the partners that you're dealing with take risk and compliance as seriously. You know, obviously from a credit risk standpoint internally, we are very geared with any partner that we bring on, understanding that it's what their credit policy is for us for origination, for purchasing the loans. If we're using them as an origination partner, we're ensuring that they're using our credit policy and they're integrating with us correctly. If we're going out and selling these loans in the secondary market, we ensure that we are in line with compliance, that we're adhering to all the NCUA guidelines that a credit union must adhere to, and that we're not exposing any of the community banks or credit unions that we're selling to any risk. So it's you know, about portfolio risk, it's about credit policy risk, it's about compliance, it's about legal, and you got to make sure you have all of those pieces covered when you're evaluating a partner, bringing them on, and then monitoring your work as you're going forward.
Right, I understand. Now,
if I may just jump in there quickly as a fintech provider that's you know, currently offering a platform to Penn Fed, I think my experience in going through that process with them was actually one of the best that I've seen in my 10-year experience in this industry. You know, I think the way that Jay has structured the organization to not just keep all of those points in mind, but also to segregate and delegate those responsibilities almost as if it were an assembly line, has been, you know, probably one of the best experiences I've had so far in my time.
And it wasn't really structured that way even 2 years ago. I mean, we have 34 fintechs right now that are either up and running in the process of integration, or in what's called our TPRM, third-party risk management contract process. And to do that, I had to bring basically 13 individual stakeholder departments together that required 17 different approvals. And it's everything from accounting to legal to finance to treasury to you know, the different parts in IT. And we had to structure it really as a project and as a process that everybody can adhere to, and then provide monitoring and oversight, not only to the outside people that we're integrating with, but also to our IT partners that might be helping us to integrate with, and all of the internal stakeholders, and making sure that everybody understood exactly what we were doing, and there's complete transparency of where we were, what we're doing, and that no funny business is going on.
I think that's a really interesting
topic.
topic.
Not to beat a dead horse, but I think one other important point, and you know, Mike was speaking to this ahead of the panel discussion this afternoon around how he's structured his compliance team, and similarly, Radius was honestly one of our first clients. They signed up with us about a couple of years ago, and his whole team, alongside their compliance and vendor management process, we were able to get that up and running very quickly, and we also learned a lot from Radius in the process. So we're obviously very appreciative of that relationship too.
Wonderful. Now that brings up a great point. So onboarding is traditionally a very tough thing for banks, whether it's onboarding customers, vendors, or in this case, partnerships. Mike, how do you coalesce a team around your marching orders in order to streamline the process of getting FinTech partnerships up and running, get them up and running quick, and sort of making hay there?
Yeah, well, I think Jay said a lot to it. You kind of got to have a culture around it. I mean, the first thing I would tell you is you got to be committed to bringing them on, right? So if you would go into a traditional bank and toss up FIS and a FinTech as a choice, right? And unless otherwise directed, the bank's going to choose the safe and average solution. And I'm not trying to call FIS average. I'm just saying that at the end of the day, if you want something that is better than most, that's how financial technology companies came into being. They could deliver something that was better than the product and service that we've had. They've proven themselves to be successful, at least a bunch of them. So if you want that, you've got to be able to say, I'm going to get outside the box and I'm going to do something different. And so you got to get over that hump. You got to be committed, and that's got to come from the top of the house. You got to sit there and say, to your compliance guy, to your risk guy or a woman, say, you got to be able to find a way to say yes, right? So that's the one thing. You got to turn it around culturally from the top of the house. Tell me how I can do it versus don't tell me, why I can't. There's 1,000 reasons why you shouldn't. And then you leave the customer with a less than great experience. But there's a whole bunch of reasons internally you can justify that. We can all justify why we give a client an average experience inside the banking business, because you got regulators, you got risk, you got all this stuff. So it's got to come from the top of the house. You got to have people who kind of are kind of paid to say yes rather than paid to say no, right? So there's a whole culture there about what people's jobs are, what they're supposed to do. Jay said it right. You got to have all the stakeholders in the room. You got and you got to commit to a quick decision, right? So at the end of the day, there will not be a FinTech that wants to work with you if it takes you 2 months or 3 months to make a decision to go work with them, right? So the world is moving too fast. So you got to be able to learn how to make fast decisions, learn how to limit the risk to a fast decision, right? So because you're not going to get all the answers, and you're going to take some risks. So how do you manage that risk down the road? Accept the fact that things are going to change. So again, when you're dealing with like a standard technology integration from the old school technology, it's going to take 12 months, and this is the way it's going to go. And you're going to have a couple of hiccups, maybe a couple of delays, but man, when you're working with a FinTech, you're going to hit a roadblock periodically and say, oh crap, I didn't recognize this. I didn't see that. But are you prepared to move around it? Well, you better be, right? Or you're going to have a whole bunch of stuff. So the team has to be dedicated to getting it launched fairly quickly. We will not take on a project that takes us more than 4 months to launch from day one to launch, projected launch time. Now, it could go 6 months if we get delays. But if we can't get it done in that short period of time, we're not doing it. It's not worth it. It's too much risk associated with it. So culture from the top, commitment from the top, right people in the right jobs, learn how to say yes, make quick decisions. Those are some of the things that have helped us along the way.
So Mike, when you say commitment, is the fact that you got rid of your branches and said, we're going to go branchless, is that the level of commitment that the CEO needs to establish?
Well, it helped to not have a bridge behind you, right? So, we said we're going to go, we cut the bridge. There's no going back. So, it helped me with the board too. I'm not going to kid you. It's like, well, for the first bump in the road, you have a couple board members that say, okay, let's go back to branches. No, they're gone, right? We don't have it. We can't go back there. We can only move forward. So that helped. But I think the commitment is a little bit bigger and broader in that from a cultural perspective. You got to believe that the technology you're getting is is going to be something that's important to your client. So I would go back to the old school. We all say client is number one. There's not a bank. Every bank, you want to read their strategy statement. You want to read their culture statement. It's like the client is number one. Well, I'm not sure. When you choose a average technology solution over a superior one because of what you perceive as risk hurdles, then you really haven't put the client first. Find a way to hurdle the risk, put the client first, make sure they've got that experience. And you got to probably believe at the end of the day in the back of your mind that Amazon and Apple are your competitors and that their experience is going to be the one that you should be concerned about most.
Wonderful. Interesting. Now, Cindy, you talk to a lot of different banks. You know, everybody sort of knows who you are as your role in the ICBA. What are you hearing from either constituent banks or friendly banks and colleagues, what their concerns are with starting up with FinTechs, and sort of how would you address them? And then would you give any advice to the FinTechs out there that are trying to sell into banks, you know, how they could maybe proceed in a way that banks would be more receptive?
Right. Well, I think generally for community banks, the biggest hurdle has been, it's twofold actually. Actually, the core processor has been a major hurdle because the FinTechs, a lot of times can't get a good integration or a good interface. And if you do, the burden of cost has been put back on the community bank. So that, you know, they basically try everything they can to force you into their products. They're safe, sometimes archaic products. So that's a huge challenge. And to Mike's point, I think you just have to be committed and go outside the box and you know, find a way around it. And the other hurdle has been traditionally the regulator acceptance. You know, if they're just worried about all these technology companies out there hooking up to your core systems, and cybersecurity's been front and center. So I mean, those are hurdles. They're not insurmountable. And I do think that we will see a paradigm shift in banking. I think particularly on the deposit side, but really the loan side as well. And banks are going to have to really pressure their processors to allow these FinTechs to access the systems so that we don't have to run dual models and do a lot of manual work. But I think the associations, I know ICBA's got their FinTech accelerator where they're bringing in FinTech companies for community banks to look at, kind of a wish list, most wanted. But I think you're going to see that ramp up really quickly in the next year or so, because those banks that aren't going to embrace FinTech, I think they're going to be at a huge disadvantage.
Interesting. Now, Garrett, what when you talk to banks and credit unions, what are their biggest concerns with you, and are, you know, many of them in that way that, you know, you would get a traditional technology provider like a core provider, and are they surprised when they talk to you at how easy it can be?
Sure. So absolutely, I think that they are surprised. I think that the idea of establishing those partnerships is really branded alongside what you know, what Mike was describing as you know, a core integration that's, you know, very predictable but very long term, with a couple of hiccups along the way. So I think that's kind of standard parlance for when a lot of the institutions that we work with think about how our platform can benefit them and how they can stand it up. I think the conversation, I would bifurcate it between large institutions and small institutions. I think on the larger side, there's a lot more stakeholders that you have to get engaged in the process. There's a lot more decision makers along the way. And then I think in order to stand it up and really operationalize and commercialize it, that's a much longer process than perhaps for a smaller community bank like Cindy and Mike, where, you know, as long as the top of the house has been bought into the process and feels comfortable with the provider, that it can happen in a matter of days, depending on what the technology is, obviously. And I think one thing to Cindy's point about the paradigm shift, I think, you know, we kind of started this process where we were thinking more about partnerships, and now I think we're looking at it more from a platform perspective. You know, a company like Community Capital, we scale alongside a mix of clients. You know, we don't operationalize and stand up our platform with just one customer. That's something that's historically been done in the past and one of the ways that it's been viewed. Whereas now I think a lot of the companies are looking at platforms, whether that's on the client side, whether that's through APIs, whether that's through analytics, or whether it's through marketplaces, not just marketplaces where you can trade loans, but also marketplaces where you can trade services, where, you know, you can aggregate customer benefits, things of that nature. So I think that the conversation that we're having right now has shifted slightly from just a peer-to-peer partnership and more towards the platform itself. One thing I would add to that, which I think everybody's spoken about so far, is the culture fit. I do think that it is important that we as an organization also map to the culture of the institutions that we're serving. And we've kind of built a culture internally at Community Capital alongside all of our team members that has a good understanding of how we can fit into the culture of the institutions that we're working with. So I think that's a very important thing to keep in mind as a FinTech tries to acquire new relationships.
Interesting. Now, Mike, you talked a lot about the commitment it takes, and, you know, we touched on, you know, how you got rid of the branches and, you know, really cemented that there. How do you specifically like pull in new ideas for partnerships? Like what process have you built at Radius that has been so successful? Can you give people maybe a little bit of granularity around that?
Yeah, so it started off fairly simple in that, you know, once you have developed a reputation that you can and want to work with FinTechs, you'd be surprised how many FinTechs want to talk to you, right? So I think, you know, to the extent you get a winner and that you get a reputation in here, the FinTech community hears that, oh boy, you know, Mantle just started to work with Radius, and they launched a program in 4 months. Oh, gee, let's go talk to Radius. So it's been good from that perspective. So we haven't had a real issue in trying to find FinTechs, but we have developed an organization that says we have kind of a filter. You know, I'd call it a sales professional that works with those companies that call us. So 95% of the work we do is people calling into us. And then there's the filter that we've all talked about to say, okay, does this company match up culturally? You know, is this the type of product we want? Is this the type of company we want to work with? And so we have a filter there. And so that's how it works. And then we take it to a kind of committee that would say, okay, it's passed through the filter. It's our pipeline meeting. And it's like, okay, you know, Community Capital wants to work with us. What makes them great? Well, you know, frankly, not to put the plug in, but Community Capital was easy. It had a platform. It had a cultural alignment. It was going to be easy to use. And it's like, okay, that's great. Some companies come to us and they don't have compliance people. Like what Jay said, well, we're not going to do business with somebody who doesn't have a compliance person on board. But we do have an organization. So we have a team of people that are dedicated to working with FinTechs from both a customer experience perspective. We call that emerging technologies. That's the experience we want to be able to add to our clients. That emerging technology handles FinTechs that want to work with us on that perspective. And we have banking as a service, which is a line of business for us, for which FinTechs that want to come to us and work a little bit more like Jay's organization and kind of be a part of us providing our charter and being able to work with them on a variety of different products. So we are organized around this important initiative for us. And, you know, I can't leave this without kind of echoing some things that Cynthia said about the core, right? So, you know, it's something that I find with everybody, and we're all talking about how banks can work better with FinTechs. I would tell you that if you are obsessed with your core and you think about how your core needs to drive your business, you will never work with a FinTech. Okay, so you've got to get over the fact that the core isn't the end all, okay, and that you've got to be able to say to yourself, the client is most important, and then my core is going to have to react. And again, maybe a shameless plug here for a partner, but a company called Treasury Prime that we work with is like the plumbing between the core and the client experience, and they're an outstanding company. And you know, they're out there, people who can find ways to work with your core to get your client the right experience. But you got to make that commitment. That's part of the organizational structure. You know, 95% of the banks would say, you know, I got my core and I got to respond to it. Well, that's kind of crazy when you think about, I don't know who stock trades based on your core. Mine doesn't, you know what I mean? But your stock's going to trade based on the number of clients you've got.
No, very well said. Now, Jay, to you, you know, in a large organization, how do you sort of push forward with this, you know, FinTech partnerships and attempt to eliminate some of the friction that goes along with bringing new ideas in a bank, which are very traditionally minded?
So, yeah, I think I don't want to just be redundant, but you know, Mike has covered a lot of this territory. But I'll just tee it off here. You're going to have buy-in from the top. You got to have the thought leaders. I mean, we have an amazing CEO who has really transformed PenFed over the last 5 years. Really believes in the FinTech partnerships. We've had a person who has the number two, who's been at the credit union for 40 years, and he's driven everything for us. And he's run business development, and he's the number two. So obviously he believes in driving things forward. And we've brought on a new CFO who basically is believing in the whole originate to sell model and everything that we're trying to do here with Community Capital and others. And then we have a new person running all of the consumer banking, and they're highly supportive of everything that we're trying to do with all the FinTech partnerships, and has made it part of the core strategy. So it really started with them, and they're the folks who brought me in. And so if you have that, then the question is okay, do you have the process? And if you have the process, that's great. If you don't, you got to build it. If you then want to go to the next step, then you've got to make sure that you actually have the buy-in from all the stakeholders. And of course, there's a corporate culture, and whenever you're coming in from the outside, you really can't build that from the bottom up. You got to go and you got to have it from the top down there. It's not going to come from the board or the people I just mentioned. It's going to come from the stakeholders. So there's a matter of socialization in a large organization of going around and getting every single person's buy-in, because one person can upset the apple cart, especially when you're trying to do something new. Because like Mike said, it's easy just to do the status quo, and banks have traditionally, that's how they tend to fail, is because the middle managers go in and they collect their 10% bonus by just getting 5% more business every year, just in their little vertical, and they're not paid to do anything new. So where you get punished is when you do something new and then you fail. So the other thing I would say, just teeing off a little bit on what Mike said, is fail fast. That's one of the things that the FinTechs taught me is, if you have these big, 2-3 year long development programs. I started at Navy Federal, largest credit union in the country. We had these 3-year, 4-year programs that turned into 8-year programs. That's a good way to ensure that you never get anywhere. When we started getting rid of those programs and started moving faster, that's when Navy Federal really grew. And the FinTechs have just taken that, and you can see that that's how they've really become successful. If they're going to fail, they fail fast, and then they pivot their model, and then they change. We as banks and credit unions can do the same thing, but don't get wrapped around these 2-year programs that all of a sudden you're 2 years in it, and it's another 2 years. So I'll leave it at that.
Now, Cindy, like I said at the beginning, you founded your bank in a crisis, and, you spent a lot of time in Washington doing some influential work with the ICBA. it sounds like in some ways you're just getting started with part of your FinTech journey. You know, how have the last few months maybe caused you to think differently? And where do you think your organization is going to go, you know, in the future?
Well, again, I think just in light of this crisis that no one could predict this year, that it really got us off the back burner and really established a new sense of urgency and survival of the fittest, if you will, because banks are going to have to be innovative, and we are going to have to force ourselves to take risk. And look, your core provider, I think Mike said it, or maybe Jay, their best friend, their interest is not your best interest. Their interest is keeping you tied to them with as many products as possible. And they have made it cost prohibitive, especially to smaller institutions, to go outside their offerings. But we're going to have to bite the bullet. And you know, if you can't offer it, and I think Mike and Jay both said, and if you can't offer it fast, that I need it yesterday. I don't need it tomorrow or 6 months or a year. I need it yesterday. And so there's a new sense of urgency. And I think for our bank personally, it's really shifted our philosophy, and maybe not shifted is the wrong, maybe shifted is the wrong word. Maybe just put the gas to the pedal and really gave us the push that we needed to go out, think outside the box, go outside the line. And we saw that we did that, and the regulators accepted it, and you know, it's okay, it worked. So let's carry it on. Let's see what else we can do so that we are a survivor tomorrow. I think that's what community banks are going to have to do if they want to survive.
Yeah, well said, well said. So Mike Butler, as a leader and pioneer in banking and digital transformation, I know a lot of people are going to be looking for breadcrumbs for you. What are some of the ways you would tell other bankers to a way to measure partnerships, a way to maybe look at value a little bit differently than they would have at the past, so that they can make that commitment and they can sort of politically get folks in their institution to understand the value of FinTech partnerships?
Yeah, so our FinTech partnerships are a bit different than Jay's, for example. Ours are based on predominantly, when I think about them, I think about the customer experience, right? So I think it's about our ability to open up a DDA account in 3 minutes online and have a great experience, right? It's our, you know, your ability to have a wonderful experience with your mobile deposit or things like that. And I think what you've got to ask yourself as the CEO of the bank is that will customer service and the ability to deliver a virtual technology-based product set be a game changer for whether or not a client wants to do business with you? And I think that's what you really got to get to. And if you believe that your branches will still represent the sole source of your clients and that you can serve them just through the branch network, then you probably shouldn't dip your toe in technology. But if this event and others over the last 12 months have kind of enlightened you to the challenge associated with delivering a service through a branch network or the demand that's coming from clients, you got to take a move towards this technology kind of world, and you're going to have to accept that the world in which we operate today, the technology, the way it's delivered is not where the answer is. The answer lies in these partnerships that we've talked about as a solution to enhance the client experience and find a way to get those guys into your bank. But you got to believe it first, right? You have to believe that that's your strategy. And I'm not critical of anybody's strategy. It's like if you're in a situation in which your branches are the source and that your technology is third or fourth on the list, then you're okay. But for us, technology is critically important, and we've had to open up the door. So You got to understand where you're going. You got to believe in the strategy. Once you believe in the strategy, commit to the culture and start to find ways to say yes to bring these guys in. But those would be I think you got to get there first if it's ever going to work, because there's a lot of reasons to say no. A lot of reasons to say no.
Now, Jay, if Mike's the guy that's going to give us inspiration and get us started, what would you counsel someone in order to stay in the fight and to keep sticking with technology, even if maybe they fumbled out of the gate or, wasn't necessarily confident right at the start?
Well, so let's go back to the failing fast. If you fail fast, that's great. It doesn't mean necessarily that that the idea was wrong. So you have to go back to the core idea and what are you trying to do here, and do you need to pivot? And so part of it is making sure that if you don't have it right now in your institution, as Mike was kind of saying, you have to develop the corporate culture of that strategic agility. Otherwise, you're just not going to be successful. You have to have the strategic agility from a business side to be able to pivot. And pivot those business models when things are not working, and decide, well, okay, was the core idea wrong? And if it wasn't, then how are we going to get it done? And I think if you're not trying to figure it out how to do it with technology, you're probably not going to be very successful in the long run. So if your short-term strategy doesn't involve technology, then your long-term strategy really should. So, being able to pivot, having the capital agility also is very important. And so it goes into the idea of the whole reason why we're doing business with community capital is that we want to have the ability to flex the balance sheet as things move. As you move into things like COVID here, we went from having a complete emphasis on expanding our personal loans and our unsecured lending. Well, now lots of people want to buy our solar loans. They want to buy our auto. And so we're pivoting that model and moving to that direction. It doesn't necessarily mean that the personal loan strategy was wrong. It just means that we have to have the ability to flex and change.
Wonderful, wonderful. So I think we're at the top of the hour. We're gonna start to close up. Garrett, can I maybe have you lead off here? What closing advice would you give, either for a FinTech or for a community bank or credit union on their journey here with FinTech partnerships?
Sure. So thanks again to all the panelists. I really enjoyed the conversation and certainly learned a lot here today. So we appreciate you participating. And I would say that following the 2008 crisis, and I think Cindy kind of pointed this out a little bit earlier in this discussion, I think everybody retrenched really into a regulatory and compliance mode where, the competing values around whether you look inward and source for stability versus looking outward and being flexible was really the name of the game. So I think, going forward, I think institutions need not make that same mistake this time. And fortunately, in many circumstances, institutions have been forced to adapt and leverage technology to satisfy some of the demands of this current crisis. So on a go-forward basis, I would remain outward-looking and flexible.
Wonderful. So I think we're going to wrap it up right here. So I'll ask each one for just a closing thought. Cindy, what would you tell to other bankers in order to, maintain an idea of innovation and creativity as they face this crisis? How would you keep them going during this time?
I think, again, we have to first look to what the value-added proposition is. And that would be the value-added proposition, not only to the customer, but to the bank as well. And then it's a risk versus reward. But at the end of the day, all we have is our customer base. If we don't have a customer, we don't have a business. So I would try to look and see what I enjoy from other companies that I deal with. And we've had that discussion at our bank. What are some innovations from other industries that make your life easier, that make you enjoy doing business with the Amazons of the world or whoever. And how can we tailor that into our business model so that, you know, we can't become Amazon tomorrow, but by just taking some smaller steps, but yet willing to take those steps as aggressively as possible, how can we make our service delivery better and make it a better overall customer experience?
Wonderful. Thank you so much. Now, Mike, how about you? What about a final thought for all our banking constituents out there?
Yeah, I think I'd play off of Cindy's commentary a little bit and say, you know, probably you don't have to boil the ocean to go from a branch to a technology company. There's a way to start, get started, take on a project, get it accomplished, prove that you can do it, and then build upon it. But there's ways to get going, and it doesn't have to be all at once. Take some small steps, prove that you can do it, because I know you all can if you want to. And you know, again, not to put a plug in, but Community Capital is an easy company to start working with. And so there's one to start.
Wonderful.
Right.
Now, Jay, how about you? What advice do you have for your fellow bankers and credit union folks out there?
Well, this may seem a bit unrelated and a bit common sense, but build a culture of empathy. Times are tough. They're really tough for a lot of people. And fortunately, you know, I think we're all blessed to be in the financial sector, which is not, in a lot of cases, not as tough as the rest of the country. But you need to have empathy for the consumers. You need to have empathy for your partners. You need to have empathy for your work teams, and for the people you report to and your boards. Realize where everybody's coming from, and they may be coming from a completely different place than they were, you know, 30, 60 days ago. If you build that in, you know, and make sure that holds up your core values. I mean, our core values are service, innovation, collaboration, respect, and integrity, but none of them work without empathy. And if you build empathy into your organization, it'll develop into your user experience. It'll develop into your teams. It'll develop into everything that you do as a company.
Wonderful. Thank you so much. Now, Garrett, why don't you take us out with a closing thought?
Yeah, I mean, I think I may have been a bit premature, but you know, my closing thought would be to remain outwardly focused and flexible. I think making the same mistake after the 2008 crisis of retrenching actually caused a lot of, not just the FinTechs that actually collaborate with banks, but those that compete with banks to actually take quite a bit of market share from the banks. So that is a direct correlation to you know, the thinking that being retrenched and looking towards stability and, you know, focusing on regulatory and compliance issues overwhelmingly is the cause of that. So my closing thought would be to remain outwardly focused and flexible.
Wonderful. All right. Thank you all so very much. So we're going to wrap up right now. I'd like to take the time to thank everybody for joining us on the call today, as well as our wonderful panel. I'd like to wish everybody a happy and safe Memorial Day. And thank you so much. Take care, everyone.
Thanks, John.
Thanks, everyone.
Thank you.
Thanks, everybody.